Most people think losing money is the worst financial mistake they can make. But here's the uncomfortable truth. The real mistake is being too afraid to risk anything at all. Because while you're protecting your money from loss, you might also be preventing it from growing. If you're interested in learning practical ways to build wealth and improve your financial decisions, subscribe to the Wealth Plugs channel and let me know where you're watching from in the comments. Now let's talk about something that silently destroys financial growth for millions of people. The fear of losing money. This fear shows up in simple, everyday decisions. Someone wants to start investing, but keeps saying they will do it later. Someone wants to start a small business, but worries about failing. Someone hears about opportunities but decides to keep their money sitting in a savings account instead. At first, that feels like the safe choice. But over time, that safe decision can become extremely expensive. Because money that never moves rarely grows. And the people who build wealth understand one important truth. Risk is not the enemy. Uncalculated risk is. So in this video, I'm going to walk you through the real reason fear of losing money blocks your growth, and how you can start making smarter financial decisions without feeling like you're gambling your future. Let's start with the first problem. The first problem is confusing risk with danger. Many beginners assume that any investment automatically means high risk. They imagine losing everything overnight. But in reality, most smart investors are not gambling. They are managing risk. For example, if someone puts all their money into a single unknown cryptocurrency hoping it explodes in value, that is speculation. But investing in a broad market index fund that represents hundreds of companies is a completely different approach. An index fund spreads your money across many businesses instead of relying on one. This reduces risk significantly. A common example many investors use is the S&P 500 index fund, which represents some of the largest companies in the United States. Historically, the market goes up over long periods of time, even though there are short-term ups and downs. The key difference is understanding the time horizon. Someone who invests for 1 month is exposed to volatility. Someone who invests consistently for 10 or 20 years is benefiting from long-term growth. Fear disappears when knowledge replaces uncertainty. The second problem is waiting for the perfect moment. This is one of the most common traps beginners fall into. People say things like, "I'll start investing when the market crashes. I'll invest when I have more money. I'll start when things feel more stable." But here's the reality. The perfect moment almost never arrives. Markets move constantly, and even professional investors cannot predict the exact right time to enter. Instead of trying to time the market, successful investors focus on consistency. For example, imagine someone investing a fixed amount every month into a diversified fund. This strategy is known as dollar-cost averaging. When the market is high, they buy fewer shares. When the market drops, they buy more shares at cheaper prices. Over time, this smooths out the cost and reduces emotional decision-making. The important lesson here is that progress beats perfection. Starting small today is often far more powerful than waiting years for the perfect opportunity. Now let's talk about the third issue that keeps people stuck. Overprotecting money. Saving money is important. Emergency funds are important. But keeping all your money in low-growth environments for decades can silently destroy your purchasing power. Why? Because of inflation. Inflation means the price of goods and services gradually increases over time. If your money grows slower than inflation, you are technically losing purchasing power every year. For example, imagine someone saving money in a basic account that grows at 1% per year, while inflation averages 3%. In simple terms, their money is shrinking in real value. This is why many financial advisors recommend balancing saving with investing. Savings protect you from emergencies. Investments help your money grow. When people are too afraid to invest, they unintentionally guarantee that their money will struggle to keep up with rising costs. The fourth problem is focusing too much on short-term losses. Markets move in cycles. Some years are strong, some years are weak. But beginners often panic during temporary downturns. Imagine someone invests in a diversified portfolio, and the market drops 10% during a rough year. Fear kicks in. They sell everything to avoid further loss. But historically, markets tend to recover over time. Selling during fear locks in the loss and removes the chance to benefit from recovery. Long-term investors approach this differently. They understand that volatility is normal. Instead of reacting emotionally, they stay focused on their long-term strategy. A simple example is retirement investing. People who consistently invest over decades often experience multiple recessions, market corrections, and economic cycles. Yet many of them still build significant wealth because they remain consistent. The fifth and final issue is not starting early enough. Time is one of the most powerful tools in finance. When investments generate returns, those returns can also generate additional returns. This process is called compounding. Compounding is what allows small amounts of money invested early to grow much larger over time. For example, someone who starts investing modest amounts in their 20s has decades for those investments to grow. Someone who waits until their 40s may need to invest much larger amounts to reach the same result. Fear often delays that starting point. People spend years researching, worrying, and waiting. But the biggest advantage in investing is not finding a perfect opportunity. The starting early and staying consistent. So how do you overcome the fear of losing money? There are 3 practical strategies. First, start small. You don't need a huge amount of money to begin investing. Many platforms allow fractional investing, which means you can buy small portions of assets instead of entire units. This allows beginners to learn while keeping risk manageable. Second, focus on education before action. Understanding basic investment concepts reduces fear dramatically. Learn about diversification, long-term investing, and risk management. Knowledge replaces uncertainty with clarity. Third, build a system instead of relying on emotions. Set a fixed investment schedule. Automate contributions if possible. This removes the need to constantly decide when to invest. Systems protect you from emotional decisions. And emotional decisions are often what cause the biggest financial mistakes. The truth is, every financial path carries some form of risk. Doing nothing has risk. Keeping money idle has risk. Chasing hype has risk. The goal is not avoiding risk entirely. The goal is choosing smart, calculated risk that gives your money the opportunity to grow over time. Because in the long run, the biggest financial loss is often the opportunities we were too afraid to take. If you found this helpful, like the video and subscribe to Wealth Plugs for more practical breakdowns about building wealth, investing smarter, and making better financial decisions. And before you go, comment below and tell me where you're watching from.